Hello students, in today's video we are going to learn journal entries that are passed in the books of transferor company. Generally in amalgamation what happens is the transferor companies take a decision to close down their business and form a new company. But when these companies decide to amalgamate their business, just taking decision is not enough. You need to pass several entries in their books to show the effect of same. So these are the entries that are passed in the books of transferor company when they are closing down their business. So these entries are also called as closing entries. So let us study what are these journal entries to be passed in the books of transferor company. First is entry for transfer of assets. That is realization account debit to each asset account. Note, book value of assets are to be taken. Fictitious assets are not to be considered. So first entry is for transfer of assets. Now when you are closing down your business, you have to transfer your assets to the new company. So first entry is for that. So while passing this entry, we have to be careful to take book value of assets. Now what is meant by book value? Book value means the value that is given in the balance sheet. That is called as book value. That has to be considered. And second point is that fictitious assets. Fictitious assets like preliminary expenses, discount on issue of shares or losses are not to be considered. So the regular assets like buildings, machinery, stock, cash, all these assets will be considered, okay, while passing the entry. So in the first entry we will transfer the assets to realization account. Second entry is for transfer of liabilities, okay. Each liability account debit to realization account. Note, book value of liabilities are to be taken. Share capital, reserves and surplus are not transferred. Now in the second entry we have to transfer liability. So when I say liability, it means only outside liabilities, not all the liabilities that are given in the balance sheet. Here you can see share capital, reserves and surplus are not transferred, which means that you have to consider only outside liabilities like creditors, bills payable, long-term borrowings, bank loan and so on. If any such liability is given, it is to be transferred to realization account. So second entry is for transfer of liability. Third entry for adjustment of purchase consideration. So in this, transferee company account debit to realization account. So the third entry is for adjustment of purchase consideration. So purchase consideration will be paid by transferee company. So his account is debited to realization account with the amount of purchase consideration. Next is the entry for receipt of purchase consideration. Okay, shares in transferee company account debit, cash or bank account debit to transferee company account. Now this entry depends upon in what form the purchase consideration is paid. It can be paid in equity shares, it can be paid in preference shares, cash also can be paid, okay. So we have to consider the shares that are issued in the transferee company. We have to debit that. If any cash is paid, even that can be considered. And transferee company, that is the company who is purchasing the business, the account has to be credited because they are paying the amount of purchase consideration, they are giver, okay. So the entry is for receiving purchase consideration. In what form the purchase consideration is paid, that has to be taken. Suppose if the purchase consideration is paid only in the form of shares, so we have to pass entry only for shares. Their cash or bank will not be taken. I hope you have understood. Now moving on, entry for sale of assets not taken over by transferee company. Now if by chance, if the transferee company is not taking over certain assets, suppose if you have stock which is not taken by the transferee company, so this entry is for that. So cash or bank account debit to realization account. That means you are selling that asset. It is not taken over by transferee company. So when you sell the asset, cash will come into the business. So cash or bank account is debited and it will be credited to realization account. I hope you have understood this. Entry for sale of asset that is not taken over by transferee company. Now when you're closing down your business and if a particular asset is not taken over by transferee company, then you have to pass this entry wherein you will sell that asset, and whatever cash you receive, that will be taken in realization account. Next is entry for payment of liabilities not taken over by transferee company. So this is the entry for liabilities which are not taken over by transferee company. Now let's say if there is certain loan on the company which is not taken by transferee company, so you have to pay this loan. So that is, for that you have to pass this entry, realization account debit to cash or bank account. Okay, so cash or bank is going out of your business, that is why here it is credited. Okay, next is entry for payment of realization expenses. Okay, in that you have two entries. If the expenses are paid by transferor company, now this journal entries we are passing in the books of transferor company. So if transferor company, that is the company who is selling its business, is paying realization expenses, any expenses for closing down the company will be called as realization expenses. So if they are paid by the selling company, in that case the entry will be like this, realization account debit to cash or bank account. Second entry, if the expenses are paid by transferee company, then no entry will be passed in the books of transferor company. Because these expenses are paid by transferee company, the effect of that will be shown in their books and not in the books of transferor company. So when they give any realization or liquidation expenses, remember if the expenses are paid by transferor company, then this entry will come. If it is paid by transferee company, then the entry will come in the books of transferee company. Okay, next, entry for transfer of preference share capital. Now preference share capital account debit to preference shareholders account. So preference share capital, it will be transferred to its shareholders account. See, it is not an outside liability to give away to the transferee company. Now shares belongs to shareholders, that is why whatever their capital is there, it is transferred to shareholders account and it is not transferred to transferee company account. Okay, next is entry for payment of preference shareholders. So basically shareholders are the owners of the company. Okay, so whatever is paid by the transferee company to this shareholders, for that the entry is. So entries like this, preference shareholders account debit to preference shares in transferee company account to cash or bank account. Now let us assume that if the transferor company is having preference shares, so the transferee company might issue shares in return to transferee company, or it can even pay cash to those shareholders. So it depends upon in what form transferee company has made the payment to preference shareholders. Now preference shareholders can be paid can be issued preference shares in the new company, or they can be paid cash. Okay, any of the two can happen. So accordingly we will have to pass the entry according to information that is given in the problem. So we have to remember first that the share capital, whether it is equity share capital or preference share capital, it belongs to shareholders. So whatever share capital is there, that will be transferred to shareholders account. First entry is for that. Next entry is for payment. How the payment is made to shareholders, in the form of shares or cash, that is to be taken. Now next entry is for transfer of equity share capital, reserves and surplus. Now because equity shareholders are the owners of the company, all the reserves and surplus belongs to them. So it will be transferred to their account. It will not be given to transferee company account. Reserves, share capital and reserves and surplus. If you remember the balance sheet, the first point says that equity and liabilities. In that we have shareholders funds. In shareholders funds we have share capital and reserves and surplus, which means that equity share capital and reserves and surplus belongs to equity shareholders. Okay, so here we are transferring equity share capital, any general reserve or any reserve if it is available, surplus, to equity shareholders account because it belongs to equity shareholders. I hope this entry is clear. You have to transfer equity share capital, reserves, surplus to equity shareholders account. Why to them? Because they are the owners of the company. Okay, so this entry is for that. Next entry is for transfer of fictitious assets and losses. So just like they are taking the profits of the company, if there are any losses in the form of fictitious asset, even that will be transferred to equity shareholders account. So let us see what is the entry. Equity shareholders account debit to preliminary expenses account to discount on issue of shares and debentures to deficit. So if any preliminary expenses, discount on issue of shares or any deficit is there, that has to be transferred to shareholders account, because as they are owners they will take the benefit of the profits and they will also have to bear the losses. So if any such assets and losses are there, that are to be transferred to shareholders account and not to transferee company. Now the next entry for transfer of profit on realization account. Now this realization account is prepared to know whether there is profit or loss on realization, that is on selling the business. Because in this realization account we transfer all the assets and liabilities of the company. We also make certain payments like any liability not taken over, or we also sell off the asset which is not taken over, and at the end we have to determine whether there is profit or loss. So if there is profit, we have to pass this entry, realization account debit to equity shareholders account. Now ultimately the profit belongs to equity shareholders, so the entry has to be passed, that is profit has to be transferred to equity shareholders account. So remember, if there is profit on realization account, that is to be transferred to equity shareholders account. In case if there is loss, the entry will be reversed. The entry will be equity shareholders account debit to realization account in case if there is loss. So whether it is profit or loss, equity shareholders have to bear. Then the last entry is for final settlement. Now final settlement happens, it depends upon how the purchase consideration is paid. Now in the previous problem we have calculated purchase consideration. Okay, so this entry is for the settlement. Equity shareholders account debit to shares in transferee company account to cash or bank. Okay, so this entry is for final settlement, that is how the equity shareholders are paid, that is in what form the purchase consideration is paid. Now usually it is in the form of shares, right? So shares in transferee company, or if in certain cases cash also is paid, so that can be considered. So this is the last entry. So when we are closing the books of transferor company, all these entries are to be passed. I would request the students to please understand and by heart these journal entries, because in further videos we are going to solve problems using this journal entry, and it is very important to understand and learn these journal entries. Without this we will not be in position to solve the problems. Okay, with this I conclude for today. Thank you.